This just came out, and you are not going to want to miss this. Because right now, people are reaching out about this all across the country: seniors, retirees, people on fixed incomes. Everyone wants to know what just happened with interest rates and what it actually means for their money. And I have to tell you, there is a lot of confusion out there right now. So stick with me, because in the next few minutes, I am going to break all of this down in plain, simple language so you know exactly where you stand. And I will also tell you what you should be watching for in the coming days and weeks. I will keep you updated every step of the way. So if you have not already, make sure you stay with this video all the way through, because things are moving fast right now. So here is what we are talking about today. The Federal Reserve just made its latest interest rate decision, and it is sending ripples through the financial world. And the people who need to pay the closest attention are the ones who depend on savings accounts, certificates of deposit, and fixed income to get through each month. That means millions of Americans aged 55 and older who have worked their entire lives and are now counting on every dollar to stretch as far as it possibly can. I will explain exactly what this means for your savings in just a moment, so stay right here. Now, before I get into the details, I want to say this clearly: you do not need to panic. There is no reason to make any sudden moves with your money today. What you do need is the right information so you can make smart decisions. And that is exactly what I am here to give you. So let us get into it right now. The Federal Reserve has just announced that it is holding interest rates steady. That means no increase and no cut for now. This decision came after weeks of debate among Fed officials who are watching inflation data, jobs numbers, and the overall health of the economy very carefully. And while this might sound like good news on the surface, the reality for seniors living on fixed incomes is actually a little more complicated than that. And I want to make sure you understand why. Here is the thing about keeping rates where they are right now. When the Federal Reserve holds rates at their current level, it means that the interest you are earning on your savings accounts, your money market accounts, and your certificates of deposit is likely going to stay about where it is right now. It is not going up, and it is probably not going down either, at least not immediately. But here is what you need to watch. Because banks do not always move at the same pace as the Federal Reserve, some banks will quietly begin lowering the rates they offer on savings products even before the Fed officially makes a cut. And if you are not paying attention to your account, you could end up earning less on your money without even realizing it. That is something I want you to think about today. Now, for people who have been keeping their money in high-yield savings accounts or in short-term CDs, this rate hold is actually a window of opportunity, because the higher rates that we have seen over the past couple of years are still available in many places. But that window may not stay open forever. Stick with me, because I will explain more in just a moment. Here is something that matters enormously to the seniors and retirees watching right now. Social Security benefits are tied to inflation, not directly to Fed interest rates. But the two are deeply connected in a way that affects your everyday life. When interest rates stay high, it often means the Fed is still trying to slow down inflation. And for people on Social Security or SSI or SSDI, inflation is the number one enemy of your monthly budget. It is what makes your fixed payment feel smaller every single month, even when the number on your check stays the same. So the fact that the Fed is holding rates steady right now tells us something important. It tells us that inflation is still a concern, that the Fed is not yet convinced that prices have come down enough to start loosening financial conditions. And that means the cost of groceries, prescription drugs, utilities, and housing may remain elevated for some time. I will keep you updated as new data comes in, because this is something that is changing week by week right now, and you deserve to know every development. Now, here is where things get a little more hopeful, and I want you to hear this clearly because it matters. The interest rate environment we are in right now, while not perfect, is still significantly better for savers than it was just 3 or 4 years ago. Back then, savings accounts were paying almost nothing. Some were paying less than 0.1%. Today, many federally insured, and for a senior who has worked hard and saved money over their lifetime, that difference is real money every single month going directly into your pocket. So if you have not already reviewed where your savings are sitting, now is the time to do that, because not all banks are offering the same rates, and some are far better than others. Online banks and credit unions in particular have been some of the strongest options for savers right now. They often have lower overhead costs, which means they can pass better rates on to their customers, and many of them are FDIC or NQA insured, which means your money is protected. So if your money is sitting in a traditional big bank savings account earning very little, it may be worth a conversation with a financial professional or a call to your local credit union to see what your options look like right now. I will keep you updated as the next Fed meeting approaches because decisions about rates do not just happen once, they happen throughout the year, and each one matters for your savings. And right now, there is already speculation building about what the Fed might do at its next meeting. Some analysts are watching employment numbers closely. Others are watching consumer spending data, and a handful of voices are still warning that inflation could tick back up if the Fed moves too quickly. All of that will play into what happens next, and I want you to be prepared no matter which direction things go. So stay close to this channel, and I will make sure you always have what you need. Now, I want to leave you with this because I think it is the most important thing I can say today. You have earned the right to understand what is happening with your money, the Federal Reserve, interest rates, inflation. These are not just things for Wall Street to worry about. They affect the check in your mailbox, the price of your medicine, the cost of keeping your lights on, and I take that seriously. So here is what I need you to do right now. Make sure you check in with your bank or credit union this week. Ask them what rate you are currently earning on your savings. Compare it to what is available elsewhere. And if you have not spoken to a financial advisor recently, consider making that call. Your money should be working as hard as possible for you right now while rates are still holding. Because as I said, that window may not stay open forever. And the people who act with the right information are always in a better position than those who wait. I will be back with more updates as this situation develops. The next Fed meeting is not far away, and there will be more data coming out in the days ahead that could shift the conversation entirely. So keep this channel close, stay informed, and know that I am always here watching these developments so you do not have to watch them alone. You are not going to want to miss what is coming next because there are more updates on the way that affect your benefits, your savings, and your future, and I will keep you updated every single step of the way.